The window to find the best value stocks before 2026 is closing fast. The window to find the best value stocks before 2026 is closing fast. The window to find the best value stocks before 2026 is closing fast. Today, I'll break down 3 companies I believe are massively undervalued. A global insurance innovator, a snack food powerhouse, and a leader in healthy food distribution. These are the kinds of businesses that can build real, lasting wealth if you get in before the crowd. Ready to get ahead of the curve? Let's dive in. Smash that like button and subscribe so you never miss an update. Now, let's get into it. First up is 𝗗𝗟𝗏𝗧, ticker SPNT, a global specialty insurer and reinsurer that operates quietly behind the scenes, yet plays a pivotal role in the financial world. While you may not see their name in the headlines every day, their impact is felt across continents and industries. While insurance may seem boring on the surface, 𝗗𝗟𝗏 is where smart, forward-thinking money finds real value. The company's business is built on understanding risk better than most, and that's what makes it a magnet for savvy investors looking for hidden gems. They insure other insurers, operating in a crucial, often overlooked layer of finance. This means they're not just taking on everyday risks, but helping to stabilize the entire insurance ecosystem, making them a backbone of the industry. What sets them apart? A top-tier management team with decades of experience, laser-focused on disciplined, profitable underwriting and strategic innovation. Their leadership has a proven track record of navigating complex markets and delivering results. Over the past few years, they've streamlined operations, shed non-core assets, and doubled down on their core strengths. Exactly what you want from a turnaround story. This transformation has made them leaner, more agile, and better positioned for future growth. The stock currently trades at a significant discount to book value, giving you a margin of safety and the rare opportunity to buy assets for less than they're worth. For value investors, this is the kind of setup that doesn't come around often. As global risks rise, think natural disasters, cyber threats, and unpredictable economic shifts, demand for sophisticated insurance solutions grows. 𝗗𝗟𝗏's business model is built to withstand these shocks, making it one of the more resilient plays in the sector. They're not just collecting premiums, they're investing heavily in insurtech and developing innovative new products. By staying ahead of industry trends, they're positioning themselves to capture emerging opportunities and serve clients in ways traditional insurers can't. Global diversification is another key advantage. With operations spanning North America, Europe, and beyond, they're not reliant on any single market. This international reach helps smooth out earnings and reduces exposure to localized risks. Their investment portfolio is managed conservatively, generating steady income from the float, the money held between collecting premiums and paying out claims. This approach provides a stable foundation, even in turbulent markets. Analysts are starting to notice the value here, but the broader market hasn't fully caught on yet. As more eyes turn to 𝗗𝗟𝗏's improving fundamentals, the potential for a re-rating grows. The risk-reward profile is compelling, limited downside with significant upside as the turnaround continues to gain traction. For those willing to look past the boring label, the payoff could be substantial. This isn't a get-rich-quick play, it's a bet on quality management, sound strategy, and long-term fundamentals. It's about patience, discipline, and trusting in a team that's proven they can execute. Every quarter, their results show progress, improved profitability, a cleaner balance sheet, and a more focused business. These aren't just numbers, they're signs of a company on the right track, building momentum with each passing quarter. In a volatile world, insurance is essential. People and businesses need it, recession or not. 𝗗𝗟𝗏's products provide peace of mind when it's needed most, making their services indispensable. 𝗗𝗟𝗏's size lets them be nimble, targeting profitable niches that larger competitors often overlook. This agility allows them to adapt quickly to changing market conditions and capitalize on emerging trends. Insider ownership is another positive sign. When management has skin in the game, their interests are aligned with shareholders, signaling real confidence in the company's future and its ability to deliver returns. Bottom line, 𝗗𝗟𝗏 is a classic value play, a stable industry, strong management, and a stock trading below asset value. It's the kind of setup that value investors dream about. The market is mispricing a solid company in the midst of a successful transformation. As the turnaround story unfolds, there's real potential for the stock to be revalued much higher. This is the kind of stock that builds real wealth for patient investors, those willing to hold through the noise and focus on fundamentals. Don't let the boring label fool you. SPNT is a strategic, intelligent move for a portfolio built to last. Sometimes, the most unassuming companies deliver the most impressive results over time. Keep a close eye on 𝗗𝗟𝗏. The market will wake up to this story soon. When it does, those who got in early will be glad they did. If you want defensive growth with upside, this is one to watch. It's a rare blend of safety and opportunity, perfect for investors who want to sleep well at night while still aiming for growth. Sometimes, the best opportunities are hiding in plain sight, overlooked by the crowd but waiting for someone to recognize their true value. Serious Point is one of them, a hidden gem with the potential to surprise the market and reward those who see its promise early. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Let's move to our next pick and see what other overlooked opportunities are out there. Next up is 𝗗𝗜𝗦𝗧 ticker JBSS, a giant in the snack industry. While you may not see their name in every commercial, their products are everywhere, quietly dominating the shelves of your local grocery store and fueling America's snacking habits. They're the force behind trusted brands like Fisher Nuts and Orchard Valley Harvest, and they're also a major supplier of private label snacks for top retailers. That means when you pick up a store brand bag of nuts or trail mix, there's a good chance JBSS made it. JBSS is all about consistency, steady profits, growing dividends, and products people buy every week, no matter the economy. Whether times are good or tough, people still reach for snacks, making this business incredibly resilient. Their operational excellence, from sourcing to packaging, keeps costs low and quality high, even when commodity prices fluctuate. They've built a reputation for efficiency, using state-of-the-art facilities and automation to stay ahead of the competition. Financially, they're a cash machine, strong revenue, a healthy balance sheet, and a history of rewarding shareholders with dividends and buybacks. Their disciplined approach to capital allocation means profits are put to work for investors. JBSS adapts to trends, leading the shift toward healthier snacking with organic and all-natural options. As consumers become more health-conscious, JBSS is right there, innovating with new products and cleaner labels to meet demand. Their private label business is a stable, underappreciated revenue stream, trusted by retailers like Walmart and Costco. These partnerships provide a steady flow of orders, insulating JBSS from the ups and downs of branded competition. The company trades at a reasonable valuation, often overlooked by the market, perfect for value investors. While others chase hype, JBSS quietly delivers real results, making it a hidden gem for those who do their homework. Their competitive moat is huge. Decades-long relationships with growers, efficient processing, and retailer trust are hard to replicate. These deep partnerships ensure a reliable supply chain and consistent product quality, giving JBSS a lasting edge. Smart strategic acquisitions expand their reach without unnecessary risk. JBSS doesn't chase flashy deals. Instead, they focus on bolt-on acquisitions that strengthen their core business and open new markets. The Sanfilippo family's active management ensures a long-term focus, not just short-term gains. Their hands-on leadership and generational commitment mean decisions are made with the future in mind, not just the next quarter. Their clean balance sheet and low leverage mean they can weather economic storms and seize new opportunities when others are forced to cut back. JBSS can invest and grow, taking advantage of market disruptions. JBSS's performance is remarkably consistent, steady growth, reliable profits, and no disruptive tech threats on the horizon. In a world of constant change, this kind of predictability is rare and valuable. This is a sleep-well-at-night stock, forming the bedrock of a diversified portfolio. You can count on JBSS to deliver year after year, without the drama or volatility of trendier stocks. For investors seeking stability, growth, and income, JBSS is a standout. It's the kind of company that quietly compounds wealth over time, rewarding patient shareholders. You're buying a real profitable business that people love and buy every day. From family gatherings to office snacks, JBSS products are part of daily life for millions. The global demand for healthy snacks is only growing, and JBSS is poised to benefit. As more people around the world seek convenient, nutritious options, JBSS's reach and reputation put them in a prime position to capture this growth. Their pricing power protects margins, even in inflationary times. When costs rise, JBSS can pass those increases along, keeping profitability intact and ensuring long-term sustainability. The market may not give them headlines, but the results speak for themselves. While others chase the next big thing, JBSS quietly outperforms, quarter after quarter. Simple, consistent, and highly profitable. JBSS is a value investor's dream. It's the kind of business that doesn't need to shout to be heard by those who know what to look for. Don't overlook the power of boring businesses that quietly deliver. Sometimes, the most unassuming companies are the ones that build the most lasting wealth. Add JBSS to your watch list for a blend of stability and upside. It's a rare find in today's market. Dependable, growing, and still flying under the radar. Now let's look at our final pick. Healthy food distribution is next, and it's an area with even more potential for long-term investors. Here's where the real, deep value lies. So stay tuned as we uncover the next opportunity. Our third pick is United Natural Foods, Inc., better known as UNFI, the backbone of North America's healthy food supply chain. While you may not see their name on the products you buy, their influence is everywhere, quietly powering the shelves of your favorite stores, and ensuring that healthy, organic options are available to millions of people every day. If you shop at Whole Foods or spot organic products at your local supermarket, there's a high probability that UNFI delivered them. They're the silent force behind the scenes, making sure that everything from fresh produce to specialty health foods gets where it needs to go, on time and in perfect condition. UNFI acts as the essential link connecting thousands of retailers, big and small, to the booming demand for natural and organic foods. Their vast logistics network stretches across the continent, moving products from farms and manufacturers to store shelves with remarkable efficiency. The health and wellness trend isn't just a passing fad, it's a generational shift in how people think about food. Consumers are more conscious than ever about what they eat, and UNFI is right at the center of this movement, helping to shape the future of food in North America. Despite their critical role, the stock has been beaten down due to concerns over debt and thin profit margins. But for savvy investors, this has created a deep value opportunity, one that's often overlooked in the rush for flashier growth stories. Their long-term partnership with Whole Foods, now owned by Amazon, provides a massive, stable revenue base. This relationship not only anchors their business, but also gives them a level of credibility and scale that's hard to match in the industry. UNFI isn't putting all its eggs in one basket. They're actively diversifying their customer base, serving everyone from national grocery chains to independent local stores and even e-commerce platforms. This broad reach helps insulate them from the ups and downs of any single customer or market segment. Management is laser-focused on executing a turnaround. They're improving operational efficiency, optimizing distribution routes, investing in technology, and, crucially, paying down debt. These efforts are already starting to show results, setting the stage for a more profitable future. Right now, the market is pricing UNFI as if it's on the brink of failure. But when you look at their assets and infrastructure, distribution centers, fleets of trucks, and deep supplier relationships, it's clear these are irreplaceable foundations that would cost billions to replicate. As an investor, you're buying real, tangible assets at a steep discount. These aren't just numbers on a balance sheet. They're the physical backbone of the healthy food revolution, and they give UNFI a powerful competitive moat. Their scale in the natural and organic space is unmatched. For a competitor to catch up, it would take years of effort and billions in investment, if it's even possible at all. That's a huge advantage in a market that's only getting more competitive. Debt reduction is a top priority for management, and as the company chips away at its obligations, more profit will flow directly to shareholders. This financial discipline is key to unlocking long-term value. Even small improvements in profit margins could drive significant earnings growth, given UNFI's massive revenue base. A tiny shift in efficiency or pricing power can have an outsized impact on the bottom line. UNFI's private brands, like Woodstock and Field Day, are another lever for growth. These brands offer higher margins and give the company more control over the value chain, allowing them to respond quickly to changing consumer tastes and trends. This is a classic contrarian play. Right now, sentiment is at rock bottom, but the underlying fundamentals are strong. Sometimes, the best opportunities are hiding in plain sight, waiting for the market to catch up. The risk-reward profile here is highly skewed to the upside for patient investors. If you're willing to look past the short-term noise and focus on the long-term story, the potential returns could be substantial. As long as people want to eat healthier, and all signs point to this trend accelerating, UNFI's role in the food ecosystem is secure. They're not just riding the wave, they're helping to create it. Yet the market continues to ignore the company's strategic importance and undervalues its assets. This disconnect between perception and reality is where opportunity lives for investors willing to dig deeper. For those willing to look past the headlines and do their homework, UNFI stands out as a compelling deep value opportunity, one that could reward patience and conviction. Make no mistake, this isn't an investment for the faint of heart. Volatility will remain, and there will be bumps along the way. But with high risk comes the potential for high reward, especially when the fundamentals are this strong. Sometimes the best investments are found in companies everyone else has given up on. History is full of comeback stories, and UNFI has all the ingredients to be the next one. UNFI is one of those rare chances, a company with real assets, a critical role in a growing industry, and a stock price that doesn't reflect its true value. If management delivers on its turnaround plan, the market will have no choice but to re-rate this stock, potentially delivering outsized gains to early believers. So keep UNFI on your radar. It could be the comeback story of the decade, and a testament to the power of patience and conviction in investing. Let's wrap up. There you have it. 3 undervalued companies: Sirius Point, 𝗗𝗜𝗦𝗧 and United Natural Foods. Each offers a unique path to value, but all share strong fundamentals and market mispricing. Want deeper analysis and real-time alerts? Join the Stocks Galore Patreon, link in the description. What's your top metric for finding value stocks? Share your strategy in the comments below. Don't forget to like, comment, and subscribe for more investing insights. Thanks for watching. See you in the next one. Let me know if you need further tightening or adjustments.